Hello, welcome to Actuary Voices, the podcast from the American Academy of Actuaries. I'm your host for this episode, Ted Gotsch, and today we will be speaking to three men who are playing integral roles in the Academy's Insuring the Future Insurance Investment Summit, which is being held May 22nd and 23rd in New York City. This event brings together investment actuaries, asset managers, and insurance executives from life pension risk transfer, health, and property casualty sectors to engage with industry leaders, regulators, and peers. It's an opportunity to explore the rapidly transforming landscape of insurance asset management through dynamic discussions, expert insights, and strategic connections. Academy members and non-members are invited to attend. For more information and the register, head to www.actuary.org. Joining us today is Jason Kehrberg, Vice President of the Academy's Life Practice Council, Steve Smith, Chair of the C1 Subcommittee at the Academy, founder and head of Insurance Analytics at Neuberger Berman, and moderator of a session on the role of equity in ALM for long-duration lines of business, and Jared Wilner, a partner at Mayer Brown, who is a participating speaker on the investment strategy considerations for cross-border reinsurance session. Thank you for joining us today. I'm going to turn over to Jason to kick us off because I understand that you played a prominent role in coming up with the idea for the summit. So, to start, what was the inspiration behind the event and how does it fill a gap in the current landscape of insurance investment conferences?
Thanks, Ted. It's a pleasure to be here on this podcast. In a lot of ways, the industry looks to the actuarial profession to not only price products, but also to ensure that insurers remain solvent to pay the promised benefits. Ensuring that products can be delivered competitively and demonstrating solvency requires partnerships across the industry. And this conference is really intended to bring together insurance company executives and investment managers so they can share ideas and gain a better understanding of industry needs and available investment solutions in a highly regulated environment. So I think you can say the inspiration for this event really boiled down to three primary things. One was increasing regulatory focus on investments, for example, Actuarial Guideline 53. Second is just a growing importance of the investment portfolio performance for insurers' profitability. And finally, we just wanted to create a forum for insurance company executives and investment managers to connect, a forum that we really haven't seen elsewhere. So given this increasing complexity of insurers' investment portfolios and actuaries' roles in product development, valuation, and risk management, the Life Practice Council formed an investment analysis subcommittee in 2023 to monitor investment trends for the life insurance industry and assess the actuarial implications. As competitive and profitable insurance products are increasingly reliant on the performance of increasingly complex investment portfolios, it struck me that the industry could benefit from a forum such as the SOA's Refocus, but instead of reinsurance focusing on investments. So much as Refocus has proven to be a popular and well-attended forum, bringing together insurance companies and reinsurers, we're envisioning the Insurance Investment Summit as a forum for insurers and investment managers to connect. And then, I guess additionally, beyond providing an opportunity for networking amongst insurance company executives and investment managers, we have arranged a number of discussions with industry leaders on such investment-focused topics as private asset-backed securities, liquidity risk, investment strategies for cross-border reinsurance structures, and everyone who attends should plan to stay to the end for the regulatory panel. We're excited to have actuaries and regulators provide their insights and perspectives about what it means to manage assets in a regulated industry and their current areas of focus.
I know the summit is being presented by the Life Practice Council with the goal of bringing together leaders from across the insurance sector. Who should come to this event and why, in your estimation?
That's a good question. And tying back to my previous answer and with the Refocus model in mind, what we're targeting is insurance company executives in the C-suite, as well as investment managers, to create an opportunity for these individuals to connect, learn, and discuss potential investment management agreements and engage in lively discussion with our panelists about investment-related topics and investment trends, as well as asset liability management against the long-dated liabilities we see in the insurance space.
What needs does this event meet for the broader insurance industry?
Well, it's intended to provide a forum for insurance company executives and investment managers to collaborate and explore potential partnerships, in addition to learning about the latest trends in the industry through the sessions by hearing from some of the top leaders and regulators about the areas on which they are most focused.
And ultimately, what outcomes would you like to see emerge from this event, Jason?
We'd consider the summit successful along multiple dimensions here. We're looking for investment firms and insurance companies to make connections and to form new investment management relationships and strengthen existing relationships. Secondly, we're looking for the attendees from investment firms to gain a better understanding of what it means to manage assets in a heavily regulated industry such as insurance. And finally, we're hoping that insurance executives gather insights into current trends and gain a better understanding of their portfolios so that they can ask their investment managers more informed questions.
Great. Jason, thank you for those insights. I'm now going to turn to two people who are going to appear in the Insurance Investment Summit. Steve and Jared, I'm going to direct a few questions to you because I'm interested in getting your insights from your two different perspectives. We'll just start with Steve first. Why are you, Steve, why are you excited about this conference?
Just as Jason said, there are a lot of insurance investment conferences out there, but there's not another one I'm aware of that has this focus on the actuarial side, including both regulatory, risk and return modeling, ALM. I'm excited to see all of that in one place. Years ago, there was a similar conference at the Society of Actuaries, but that's been discontinued. So I think that left a hole that I'm really glad to see the Academy filling.
Jared, what are your thoughts as far as the importance of this event?
Yeah, thanks, Ted. We've just come through a period of incredibly rapid regulatory change by insurance industry standards. Now, asset managers and insurance companies are digesting those changes and adapting to a whole new world with respect to the regulation of insurance company investments, with the principles-based bond definition, the surcharge on residual tranche of asset-backed securities, and the new remit of authority to the Securities Valuation Office. And there's more change on the horizon. And so this is an incredibly timely conference to help all the relevant stakeholders think through the new landscape. And more generally, we've seen just a tremendous convergence between asset management and insurance, particularly with private equity and private credit players becoming more and more integral to the space. And so it brings all of these stakeholders together in one place.
Great. Well, thank you for that. Now, Steve, generally speaking, what are some of the top key issues in asset or investment management?
I think, at least as relates to insurance, there's really two categories of issues that asset managers and investment managers are thinking through. One, Jared just referred to, there's been an increased partnership between asset managers and insurers. There are more and more asset managers who are taking stakes in insurers and more insurers who are taking stakes in asset managers. I mean, there have been some large deals announced even relatively recently. So I think that is on everybody's minds as the world has, I think, woken up to the synergies that exist between these sectors. In terms of the actual management of insurance portfolios, I think within insurance, and this is related to the collaboration between asset managers and insurers, there's been really an increased, I think, competitiveness, in particular in the life and annuity space, where the market is demanding more and more of the investment portfolio. More and more yield is needed in order to write competitive products. So from an investment management standpoint, the question is, how do we deliver that yield without blowing out the risk budget, without violating capital constraints, without introducing volatility to earnings or to the capital ratio, to the RBC? So I think by and large, what we're really focused on is finding a way to create what the industry is demanding, which is stable, high yield.
Jared, in your mind, are there any regulatory developments on the horizon that could significantly impact insurance investment in the coming years?
Yeah, and much of the regulatory developments we've seen to date and those which are coming down the pipeline are in some way a reaction to that reach for yield that Steve just described. So as insurance companies are trying to find more high-yielding products, particularly in their kind of fixed income investment portfolios, regulators are responding to that. And their interest is to ensure that the RBC charges associated with those fixed income securities continue to accurately represent the investment risk. right? And so if a security has an equity-like reward and risk profile, it should have an RBC charge for equity or something like it. And so the three big areas of regulatory development that I briefly mentioned at the top of the call, the new principles-based bond definition, which became effective January 1 of this year, the surcharge on the residual tranche of an ABS, and the authority of the Securities Valuation Office to selectively override the credit rating on a filing exempt security. These are all different and converging reactions to that dynamic. And so one aspect of this is all the industry participants kind of adjusting to that new landscape and operating under this new regulatory framework. More forward-looking, there's just been recently a new task force comprised of insurance commissioners who are going to be reviewing RBC holistically. And so it's going to be really interesting to see how that develops. It's very early days right now, and there are substantive recommendations on the table for consideration, but it'll be important to keep an eye on this, and particularly how it interacts with other ongoing efforts by the NAIC, including the CLO modeling effort. And so there is still a lot coming down the pipe and a lot for the industry to kind of react to it and digest.
My next question, I'm going to direct both. We'll start with Steve, and then Jared, I'd love to get your insights after Steve here. But what is the current state of play for insurance investments?
I'll answer that by explaining how insurers have been going about getting this increased yield that both Jared and I have been referring to. So by and large, there are a few ways one could go about getting yield. You could, if the yield curve is upward sloping, you could add duration. You can always go down to credit quality. However, those are both particularly challenging for insurers. So if you're a life insurer, for example, you're pretty constrained on duration for ALM reasons. And if you're going to be constrained on credit quality, largely for RBC or rating agency capital reasons, even if you're a non-life insurer, going below investment grade introduces volatility. Those options are largely off the table. So instead, insurers have been focusing on increasing deployments into illiquidity and complexity, where in both cases you can get paid a premium for taking on those exposures. And in fact, we really saw this trend get in motion during the period of low yields before the pandemic. I mean, really that whole period from the financial crisis through the pandemic, you had low and falling yields. You had the search for yield that went into increasing illiquidity and complexity. You also at the time had gradually, very slowly decreasing credit quality. But since the Fed hiking cycle began, we've actually seen a move back up in quality. So despite this search for yield, insurers have actually been improving the credit qualities of their portfolios. So it really is just about searching for yield through complexity and illiquidity. Now that's come through in a growing exposure to private credit. In fact, growing to the point where it's a little bit hard to measure how large the growth has been, because a lot of it has been done through rated feeder structures that I think Jared was somewhat referring to before. There's also been growth in structured securities, right? CLOs, ABS, especially esoteric and private ABS. And there's been a large reallocation within mortgage loans. We've seen, especially if you look at new originations, you've seen a large shift away from office and retail and into multifamily and residential mortgages. And that residential piece in particular, there's some really interesting yields available due to the complexity in that marketplace. What all of those, everything I just mentioned, what they all have in common is they don't necessarily require insurers to go out on the limb in terms of credit quality, but they're complex and illiquid, and that's what insurers are getting paid for. Now, of course, in that space, and Jared referred to this, that with complexity comes opacity oftentimes. So the regulators are understandably and rightfully making sure that they understand the risk that's being taken, and making sure that the whole capital framework and solvency framework is being updated to keep up with these trends.
And Jared, what's your take on the state of play for insurance investments?
It's a tremendous amount of innovation driven by the dynamic that Steve just described. And so it's a really exciting time to be working with insurance companies in the structures of these products, because the products are increasingly complicated and oftentimes for understandable reasons. But then we have to think about how those products work within existing regulatory frameworks and sort of the RBC consequences. So product innovation, it's been explosive over the last several years. I think it will continue to be. And so that's how I would describe the state of play. There's just increasing exploration of new structures and concepts, which is very exciting.
Well, I know you're both on different panels, but Steve, I'll just turn to you real quick. Tell folks, what topic are you going to be covering in the panel you're heading up?
Yes, I'll be moderating a panel that covers ALM for long duration liabilities.
Okay. And why was that topic chosen for the agenda? I mean, what are some of the industry issues surrounding that?
So there are, for very long duration liabilities, this refers to liabilities where the duration is longer than what you could get in a 30-year bond, which is really the last liquid point of the yield curve in the US. This has been a perennial challenge for life insurers, is how do you manage risk against that kind of liability? How do you manage your interest rate risk? One thing you can do, of course, is use interest rate derivatives to get enough duration against that liability. And then you've hedged out your interest rate risk so long as you believe that the entire yield curve past 30 years is 100% correlated with wherever it is on the yield curve that you're actually hedging. That might be true. It's probably not. It's impossible to measure because we don't have liquid securities past 30 years to see. If we can't actually hedge the long part of the curve, what can you do instead? And in fact, step back, what is even the risk that we are measuring against? And I think traditionally, most insurers have thought of that as largely a fixed income or interest rate exposure and managed it accordingly. Maybe they don't fully hedge out the duration, but they think of it as fixed income. That said, there's been a slowly growing trend for some insurers to think about that long-term risk differently, to say, really, the risk we care about is we don't want to run out of money in 40 or 50 years when we have to pay these claims. If you're trying to avoid running out of money, the math changes a little bit. You maybe are less sensitive to short-term fluctuations in your net asset value, and instead you start to think about, how can I get a higher return over this long horizon if I'm willing to accept some short-term volatility? There had been a proposal out there to use equity against these very long-dated liabilities. I think there's been probably less discussion on that since rates have been rising recently, but we're revisiting that. And that concept is built into Solvency II. That concept is built into BSCR in Bermuda. So we'll be discussing this proposal to incorporate it into US RBC.
Okay. Jared, tell us what topic you're going to be talking about during this event.
So I'll be a panelist on the investment strategy considerations in cross-border reinsurance transactions panel.
And why that topic on the agenda? What's some of the top line points surrounding that topic?
Yeah. So on a more personal note, I'm a reinsurance lawyer. It makes up a large part of my practice. So reinsurance is near and dear to my heart, and I'm very frequently working with ceding companies or assuming reinsurers on cross-border deals. And in every instance, a big emphasis has to do with the structure of the investment portfolio. Some of that has to do with different investment regulatory regimes in the U.S. and sort of offshore, and sort of how that figures into pricing and other aspects of the transaction. So it's a really core consideration to how reinsurance deals get done. And then the regulatory overlay on top of it is shifting. There's a new emphasis on potentially requiring some level of asset adequacy testing or cash flow testing by the ceding company in these offshore deals because of the differences in the regulatory regime with respect to the investments and how reserving gets done. So really dynamic area, incredibly important to the industry and to me personally. And I'm just more generally incredibly excited to talk through all of that with my co-panelists, Greg Halligan from Oaktree Capital and Ed Massara from Knighthead, who are reason enough to come and see the event. So I'm really thrilled to be a part of it.
Jason, Steve, and Jared, thank you for all your insights about this terrific event. As a reminder to the audience, you can still register for the Insurance Investment Summit being held May 22nd, 23rd, New York City. Go to www.actuary.org to register. My name is Ted Gotsch, and I am pleased to have had the opportunity to host this episode of Actuary Voices, the podcast from the American Academy of Actuaries. Visit our website at www.actuary.org to learn more about all we do here at the Academy. You can also follow us on X, Facebook, and LinkedIn. And don't forget to subscribe to this podcast at your favorite podcast platform. Until next time, be well.